Okay, so no particular order. Stripy shirt, jeans, new age traveller, clearly. If I can get you just go down the line, introduce yourself, and we'll kick off from there.
Hello. Yeah, name's Stephen Barker. You know, many years in traditional banking and finance, but most recently I've been an advisor to Nexus Mutual and an advisor to iTrust that are both in the DeFi insurance space. So,
thank you.
Hey guys, my name's Jonathan. I'm the CEO of Steady State Finance. We're protocol-to-protocol insurance.
Hello, I'm Ben Peach. I'm Associate Director at Aon and look after our digital asset business and also our digital asset strategy as a company.
Hello, Dan. I head up Names. We're a placement and trade platform for digital asset risk and hopefully one day all sorts of other risks.
Dan, while you got the phone, we'll start with you. So what do you see, if you like, the role of regulation in the sort of insurance market in relation to sort of, and the players that are coming into the DeFi insurance space? How do you see that currently?
Straight into regulation. This will get everyone pumped up for the after party. Yeah, I mean, right at the beginning of our journey 2.5 years ago, we took a pretty pro-regulatory approach. The idea being that you have, pure innovation at the front with DeFi, and there would be this, moving over of capital that we're already seeing from traditional finance. That bridge would be most likely a regulated one before they get into pure DeFi interaction. And so I think it's certainly heading in the right direction. I think the players that have been involved in regulation from the startup side or the operation side have worked with regulators very closely on the actual regulatory frameworks and how they'll develop. It's not a set in stone and there's a framework for you to step into and you have to tick a few boxes and that's all complete. Instead, it's been a process of figuring out how regulation can be designed so that you're or can be designed appropriately not to completely void any technical benefit. I'll give you an example of that, because that sounds a bit vague, is in insurance, one of the reasons why liquidity is relatively low post-placement is because every time you need to move risk, there's a new broker commission, there's a shareholders resolution that needs to pass, there's a huge amount of legal work, new documentation, etc. And if that sort of bureaucratic process was applied to the tokenization of risk to allow tradability of insurance exposure, there's no point in having the technology. There's no point in doing the tokenization at all, because it would be as slow as issuing a new resolution and doing all these other bits. So we've worked with the regulators to educate them on how the technology works, and we get a huge amount of education back as to why things are needed so that we can find the overlap between the two. And it sounds like a compromise. It's more a sort of positive collaboration between sort of a bureaucratic manual process and the technology itself. So yeah, and then I think the final point there is just with a regulated bridge to this world, you open up a tremendous amount of capital from the mainly institutional space that can start to in some way engage with DeFi. Either you're insuring digital assets or you're actually getting capital all the way into engaging in these kinds of protocols, which is obviously the end goal here.
So do you see then that allowing institutions to come into a market which largely has been as a result, they haven't had direct exposure, they tend to come in as either in syndicates and things like that, but effectively you're able to collectivize or unitize and offer exposure into the institutional market? And is that where you see it possibly going?
Yeah, I think it's very similar to what we've seen with custody, for example. So if you're not going to hold all your assets on chain, you hold them in custody. Maybe that custodian has insurance and is regulated, and so institutions will go there. And it's the same with insurance. If they're going to engage, for example, the insurance-linked security market, roughly $100 billion space, that capital can back catastrophic risks in the DeFi space, but will most likely do so from these regulated environments instead of purely within the smart contract. Obviously, we'd like to see the latter, but a combination of the two, where you have capital that is already on chain and ready to go, that has exposure to these kinds of risks, and then huge amount of additional capital that kind of dwarfs the market cap of the whole space anyway, has an entry point, and then over time can benefit from the efficiencies that this whole space is already seeing.
Okay, and the elephant in the room, that's you, Ben. What the hell are you doing here, representing Aon, the biggest insurance company?
Second biggest broker.
Second biggest broker.
Would have been the first, but the merger failed.
Merger failed, yeah. Wasn't the due diligence on your behalf, I hope?
Oh, no.
But no, I'm intrigued because Aon, in all seriousness, are a huge player in the insurance market. Where do they see the infrastructure sort of requirements and sort of how they can help, or how traditional businesses, from the coffee houses of Lloyd's and Chicago and Singapore, the main centers of insurance, how do you see them actually being able to help and embrace DeFi? Or is it completely the other way and they're saying, we don't want to touch it, we can't insure these risks?
It's an interesting question. When I'm talking to my clients who compromise of tier one banks in New York to large asset managers and also large institutions within the cryptocurrency game now, the Coinbases of the world, the Robinhoods of the world, we're all taking notice of what's happening in yield farming and DeFi protocols. Some of these large banks are offering, 0.5 to 1%, like on assets held with them throughout a year. And then, some of the CFOs are then having conversations with other crypto investors, and they're saying, well, we're getting 8 to 12% on our stable coins. And it's just
What's a stable coin, they say?
Yeah, and it's incredible, really. But unfortunately, some of the regulators have been taking notice too. We've seen Celsius Network and Nexo they've been told by the SEC that they're breaking some sort of securities violations by not having a broker-dealer license. So it's interesting how the US will see it, but from a market perspective, from the London market, as long as the company is incorporated, not a DAO, as long as the company has the approved licenses, controls, we'll look at insuring them. But the price will be relevant to the type of exposures that they'll be leaning on.
And those prices, are they coming down?
At the moment, we're in a massive hard market. Ever since the pandemic, rates have been going up 25% maybe, especially in the crypto space, every year. So, we're seeing massive premium hike, and a lot of MGAs, smaller insurance markets, actually coming out of some of the crypto risk because of the losses they've been experiencing on the other side of their book. So that's mostly through business interruption claims, but also the cyber markets in an absolute downfall at the moment, and there's huge losses across the book. So when you're looking at DeFi, which really hasn't been proven yet, some of them, don't have the right regulatory permissions in the insurer's eyes to be conducting the business that they're doing, it's very hard to convince some new markets to come in. So what that leaves us with Aon is we need to look to work with guys like Dan, and we have announced a partnership, we're working very closely with names, on new capital structures, looking at the ILS model, looking at key internal and external stakeholders, and how we can build an efficient capital structure to start insuring DeFi companies. Because I do believe, within the next 5-10 years, that infrastructure will be deployed across many of our traditional banking and asset management clients. So that's how I see it, and a lot of folks at Aon do.
Okay, and Jonathan, what do you see is going to be the trigger? What's going to be that inflection? How are we going to get DeFi really taken seriously in the insurance sector?
Well, we're already asking about it. How do they get involved? At some level, it's already being taken very seriously. I think when it comes to convincing insurers to want to insure DeFi, we often think, okay, immediately we want them to be insured. Like we want them to jump into a market they don't understand that's nascent. We all enter DeFi because we either believe in one thing, probably individual sovereignty, the expansion of the individual, or also we love yield, okay? You can't get yield like you can in DeFi in any other industry, it feels like. And so rather than targeting them to be insurers immediately, we should be looking at different ways to actually attract them to the industry, such as what they're saying. CFOs are talking about high yield on stable coins on interest. I think if you tackle portfolios and get them yield to portfolios before you actually bring them on to be insurers, that's how you get them involved in the industry. You get them exposure already before you get them to insurers on their portfolio. If you can offer someone maybe a yield on a stablecoin that pays you 20%, and the stablecoin is USDC, which passes a lot of regulation, collateralization regulations, then they're going to realize they're going to want to try to get more of those yields, or the products, they want to start backing the products generating those yields. And that's what I see like to be the most powerful way to bring in native insurance into DeFi is tackle their portfolios rather than get to be an insurer at first.
And Steve, where do you see, what would be one of the key things you see being able to sort of help the DeFi and traditional insurance markets perhaps work together a little bit closer?
I kind of think, it's like any allocation of capital. If you're allocating capital, it's a combination of risk and return, right? And one of the things that I think is the current state in DeFi is that, and nothing against my colleagues, but most traditional insurers don't really know how to understand the risk involved in, insuring a protocol or, or covering a smart contract. If anybody knows how much it costs to get a smart contract audit, i.e. experts to kind of have a look at the risks in smart contracts, and if you can get a guy to do it, if you can find someone to do it, you're not on a 6-month waiting list. So that kind of skill set and that kind of expertise is kind of, is lacking at the moment. And so, obviously, if you can't understand the risk, then it's very difficult to kind of allocate capital to something. So I think that as we get, like in traditional crypto, if you look back 5 years, nobody understood the risk, then nobody understood, what was, what they were putting their money into. If you're an institutional investor, now they've moved, up the curve significantly, and I think exactly the same adoption curve.
So is that just a matter of time then?
It's just time, and it will probably happen quicker with DeFi insurance than it has been with traditional crypto. Just mainly because talking about the yield there, we live in a world of zero yield, right? The only thing that's paying yield at the moment really is DeFi and property, right? Find me an asset that's paying some, other asset that's paying some yield, and I want to go in it. So that yield is kind of, attracting people, from the greed side of things. On the fear side of things, they're not quite sure yet. Once that gets resolved, I really think that, that will actually be where the growth comes, and potentially not necessarily on the retail side, but, we're talking about corporate treasurers and things like that. If they can buy a USDC stablecoin and get 8% on that, and then buy for 2%, they can buy some depegging insurance or depegging cover. They're still getting net 6%, which is better than anything they're going to get anywhere else. So,
what's pegging cover? It's not your washing, is it?
Yeah, no. It's for example, if for whatever reason, the stable coin doesn't trade 1-for-1 with the underlying asset.
What, because the stable coin's not invested in US dollars?
Well, I couldn't possibly comment on other stable
Why
coins,
not?
what they're invested in. No, but it's happened before. If you look at DAI, that's a stable coin that's not necessarily backed. That's traded below its peg before. Tether had some instances a year, 1 or 2 years ago, where it traded, for a brief period below its asset backing, and that's because of market dynamics and things like that. But it could very well, if tomorrow someone found out that
Tether wasn't invested in US dollars?
Well, it was invested in Evergrande bonds or something like
Corporate
that.
debt.
Yeah. Then you might have an issue with the peg, right? And then if it depegged, then potentially that cover would pay out. So the main risk that you're taking is almost a form of credit risk at the moment, which is either on the smart contract or on the peg. So yeah.
Okay, so that kind of leads me on to really a question for you, Jonathan, in terms of looking at sort of new forms of insurance which are focused on risk. We've got a new vocabulary, we've got pegs and depegging. That's, you know, and we're just even inventing words. And it gets really confusing, but where do you see the new risks, potentially, that DeFi can help?
Where do I see the new risks? So, I think what we're going to see for new risks, so there's this new narrative being built, which we're all probably crypto degenerates, hopefully, here, DeFi 2.0. DeFi 2.0 is the idea of protocols building new structures that utilizes the value of trusted protocols underneath. Okay, we have infrastructure in an ecosystem, right? And if the infrastructure underneath what we do something fails, that causes serious harm across the whole industry moving up. A great example, I was talking to some guys before the panel, was Alchemex. Alchemex is you can deposit DAI stablecoin, okay, into their ecosystem. And they give you what they call tokenized yield. They give you actually like 50% of the value back immediately reuse. And the value of what you lock in that ecosystem, they actually reinvest for you under another ecosystem underneath that grows at 14%. And the money they give you in advance, that money continues to grow. And as it grows, you can pull more money out of the ecosystem. So it's like a yield generator, and you can pull up your yield immediately without ever having to pay back the yield. It's a really interesting ecosystem, but it uses your finance underneath, which is a DeFi protocol, to actually aggregate that system. And then it uses DAI. Now, I'm a big believer in DAI. I love the MakerDAO system. I think it's really powerful, and I think it's here for a long term. But, you know, when you think about credit risk and like infrastructure failure, by building on top of Aave, by building on top of Curve on Yearn Finance, if Curve falters, or Aave falters, or Yearn Finance falters, that can actually have infrastructure in every protocol on the way up. So it's a financial risk. It's some kind of a counter-parity risk you have to understand. That's kind of new in the industry. I think it's a new one we're going to understand and build. And how we're going to understand that risk, we're going to understand as DeFi natives. We're going to look at that as there's going to be some kind of a social contract or trust that these things are tried and true ecosystems, even 3 years old, that's very old in DeFi, that they're not going to break. And we're going to use that as the baseline how we build out the ecosystem. So that's like the new risk, okay? It's like a brand new kind of risk that we knew existed, but like it's going to explode, right? This is like when something breaks underneath, what happens everywhere else on the top. It's important for us to make sure if we do this idea, which we need to bring DeFi forward, right? We need to build on the underlying infrastructure, bring new projects out that create better alternative yields or results, and we need to trust that. And that's the only way we can build this out. And I think that's a new risk that people are still trying to grab their head around Aave. And I don't think we've even gone to Curve Finance, but Aave and Compound, you know, what about Tokemek? What about Olympus DAO? What about Alchemvex? You know, we go over all these other crazy projects in DeFi being built now on top of Aave, right? And we now have to figure out, these guys, these regulators, these DeFi people, it's like, wait a second, if this falls here and I'm insuring this, what happens?
Well, exactly. So isn't the whole thing a bit like a pack of cards? And the systemic risk, because at the end of the day, whether you like it or not, Bitcoin still dominates a lot of the crypto market. Mm-hmm. It's a bit like American economy sort of sneezes, the rest of the world catches influenza.
Yeah.
And you've kind of got that, if for some reason Bitcoin falls over or has a substantial correction, doesn't have huge risk to something like the DeFi market.
Maybe the token price, right, or market capitalization, but we're not insuring market capitalization unless we're doing options or derivatives, right? We're insuring intrinsic risks, you know, not necessarily related to the market, like a smart contract failure, which if a smart contract fails on that project, it impacts the price. So what we're thinking more is this deck of cards, right? When we build any ecosystem, whether it's we rely the U.S. Treasury, the Federal Reserve, as the baseline for why we build all ecosystems, we're betting on the idea, we're believing the idea on a social contract trust that institution is not going to fail. And eventually, we have to place our bets if we want to build this ecosystem forward, right? This internal DeFi system before it expands out, right? We're going to have to eventually pick protocols, do our own evaluation, do our own audits, right? To try to figure out we can trust this, and it's a bet. And if you don't want to take that bet, you don't need to get involved with our ecosystem. But, you know, we have audits, right? We have trusted stress tests, like on banks, to make sure there's no infrastructure failure. We don't have that yet in DeFi. So, like, you have to bet on your ability and the group of others to be able to actually forensically analyze something, right? And make sure there's a trust there it's not going to work. There's a great project being built out, which is trying to be like a decentralized Moody's of DeFi. It's called Credmark. It's one of our partners. And they're doing just that. They want to be an ecosystem where they are constantly doing forensic analysis on what these infrastructure and these blocks are. Either this is a massive Lego strong ecosystem that's building from the bottom up, but if you have the bad underlying value right there, it becomes a Jenga set. And so the goal is to make sure the house of cards, right, it's not a house of cards, it's a strong foundation. And that's what we're trying to figure out right now. And ecosystems are making different bets on how to do that, right? It's just like with insurance. When you accept like insurance, right, you accept taking premiums, right, you re-inject it into bonds. And you're betting on, obviously you diversify the bonds as much, your float returns, and you're betting on, you're gonna create an optimal return on top of the premium to get recovery. And there's some kind of bet that certain bonds aren't gonna fail. So like, if we receive money and we move money into Aave contracts, which have never failed, that's our basically risk-free rate of return, hoping that's not gonna fail. Now maybe floating or fixed, and we can figure that out, but like, there's a model there, and there's precedent to back that. And so we gotta like think about, we're building our own ecosystem, but like, that's a new risk that regulators haven't even seen yet. It's gonna confuse the heck out of them.
Okay, all right. Ben, so going back to the old traditional world of a firm like yourself, I'm interested in what are the challenges for, if you like, traditional insurance market getting involved in the DeFi sector? And also, what are some of the challenges when you're talking to some of the underwriters about DeFi, trying to get them to explain and understand some of those risks?
They can be challenging. There are a few standout markets that we deal with, and I hope Munich Re won't mind me mentioning, but they do have an adequate technology in crypto practice. We've created a number of different products with them. One of them actually being staking cover. So in the event of a slashing event, then we can insure the insured party against that. So we do look at it, but as you said, a lot of traditional financial lines market, where most of the crypto capacity actually sits within Lloyd's of London in the financial lines market, yeah, they struggle with it sometimes, especially because of the licensing requirements. And then it all comes down to jurisdictional risk, because if you're offering products to US citizens or in highly regulated countries in Europe, or even have any Asian presence at all, that automatically will just put a lot of these underwriters off, even before you go into the back end, the technology, how it all works. And it's problematic at times, and that is why we are limited to the amount of open insurance market placements we can do for DeFi companies. And we do have Realm Insurance. Some of you may be familiar with them in Bermuda. They're a specialist crypto insurer there, and they're setting up their infrastructure to be able to provide this cover. And there are new markets now coming in to the traditional space, backed by crypto exchanges. And it's incredible. I'm having these conversations with large US players who are now re-domiciling to Bermuda to actually start writing crypto-based risks, and especially DeFi too. So it's not just us.
Is that like doing reinsurance to themselves, or are they creating reinsurance pools for others?
So captives are the instrument that a company will create to insure themselves against a loss, very standard. But what they're actually doing is they're applying for BMA licenses, a collateralized reinsurer license or a general business license, to actually start writing crypto and DeFi domicile risks. And that is interesting for us, because it was only 3 or 4 years ago that the London market was seeing those risks coming in the first place, and now they're going to be competing for capacity for future crypto programs. So we're really seeing a complete shift, and actually where the money lies and where the money is coming from for crypto insurance, because it will be the likes of Aave, who have billions assets under management, who will have the authority and the power and the money to set up these vehicles and actually be a challenger to the status quo within the London market. And as brokers, as long as they're regulated, they have their licenses, we'll be able to work with them. And I do tell a lot of underwriters this, but sometimes they do brush it away a little bit. And it might just be, I told you so in about 10 years' time.
Okay, so Ben, just to sort of recap on that, so what you're saying is you're now seeing pools of liquidity coming from, if you like, crypto land, that actually can see some opportunities for insurance products, which can be used by traditional players that are coming in. So we're seeing people like Visa, MasterCard, little companies like JP Morgan and BP, almost any company you name are getting involved in this area. So some of those crypto insurers are able to provide potential insurance type products for that type of risk, as well as the traditional insurance players looking up to sort of take on some of the risk and underwrite it.
Yeah, I mean, they would have to agree on the wording, the language of the contract, and most importantly, the currency that the contract is denominated in. So one of the things we're looking at Aon now is we're looking at pricing cover in ETH for some of our crime risks to neatly match liabilities with assets held by these type of companies. Again, the problem there is actually finding insurance markets that will accept premiums in Ethereum. Apart from one in Bermuda, none of them do at the moment. So it's what.
Hang on. We found another one. Nexus do. There you go. Who did? And die. Don't you love it when someone does that to you, Ben?
Regulated insurance markets.
So Dan, I'm interested. We were talking earlier on, and you were talking about you think it's important that the traditional world and the DeFi world can work together. And I know there's a couple of examples of where someone will come in. And I'm sure many of you, you're either working in businesses or looking to potentially set up a business in, let's call it in the digital world. And one of the things that's really, really important that you need to have is something called PI insurance, or Directors' Office and Liability Insurance. So if there is a claim against the company, you've got insurance. Now that seems to me an example where if you like, a crypto company can come to you and they've got specific crypto risks, but they've got normal business risks. So are you beginning to see that happening in the insurance space, i.e. the old and the new world coming together to create a package for companies?
Yeah, I mean, on a technological standpoint, there's obviously been a huge amount of learning that the traditional insurance space has accumulated over the past 400 years. And there is an argument to say that a bit of a fresh start is needed on a sort of infrastructure, marketplace scale level. But at the same time, there is there are parts of the methodology of traditional insurance that should be, taken over into this new way of doing things. So I think the combination of, let's say, for ease of summary, regulation, that sort of regulated institutional approach, plus DeFi protocols, combined is probably a pretty good balance to capture the imagination of the traditional insurance space. I think, just to tie in these two, the points that they were making, a lot of it is, well, there are a million new risks that are coming out of the space, and but there are also some existing ones that have been around for a while and are better understood. So, PI, for example, D&O, should be better understood. They just tend to be, tethered to the activity of the business, which is, as a whole, there are some challenges, as Ben is saying, and which sort of seems silly on the surface, but if you dive into it, there's some justification there. But you also have sort of specie, which is cold storage protection. Good 3 years ago plus, you were seeing huge volumes for that. A lot of it was just a bit of a tick box exercise for people to appeal to regulators and customers, but ultimately there's some utility there. And then you get your crime, and tech E&O is starting to become a bigger product, and now NFTs get asked about a lot, and so there's definitely capacity there. So it's going to be a rolling fit from better understood risks. Nexus have claims data and loss data that probably extends beyond most people's, and so that will only increase over time for pricing to get better. So millions of new risks. It doesn't all have to be covered from the beginning. In a perfect world, it would be perfectly priced, but the maths don't work. But there's still lots of things that we can cover now. And that collaboration between the two, I think, is relatively healthy at this point.
Brilliant. And Steve, I understand you've got a few sexy risks or interesting things that you've actually physically done. Is that right?
Potentially. Well, I mean, the interesting point, for example, about Nexus is that the first product was actually earthquake insurance. So that was the first product that actually came out, and it was basically a binary payout, and you know, you could do it as a parametric way and all that kind of stuff. Didn't take off, and obviously, you know, the product market fit came up in smart contract insurance, and you know, the rest is history. But obviously, on kind of, for example, on the Nexus side, I mean, they're writing kind of, you know, face value, you know, 50 million to 100 million a week sometimes in you know, risks over various different protocols, from the, you know, the unsexy, so the very, you know, safe stuff like Aave, for example, to some stuff which is quite exotic, and also on the centralized exchange side, for example. So another company I'm involved in, iTrust, has just done an integration with a custodial wallet called Holdenaut, which allows the customers, you know, holding their crypto in that wallet with one click to go, all right, I want this covered, bang, click, takes out the ETH, basically does the entire transaction in ETH with Nexus, and the customer who's buying it doesn't have to do the KYC, they don't have to do kind of anything like that. They basically just get an NFT which represents their risk back in their wallet. So
Steve, none of that's sexy to me.
Isn't it? Okay. Hey, I said NFT. That's kind of sexy.
What's that then?
Yeah. Yeah, I mean, look, I do know for a fact that, for example, you know, the next stage in growth in Nexus is going to be potentially risks that are kind of potentially non-crypto risks. So, you know, like any insurance pool, you know, you actually you de-risk things via diversification. You know, in banking it's via hedging, in insurance it's via diversification, and you know, there's a very strong chance that, you know, within next year there's going to be kind of there's a very strong chance that next year there's going to be various other kinds of risks that are potentially seen as non-crypto risks insured in the same pool as crypto risks, and every, you know, and as a diversification, that kind of that helps the entire risk pool.
Okay, still not sexy. Yeah, Dan.
Just a quick one. To the question of this sort of collaboration between old and new. You know, I don't know if Nexus would be open for this, but the general idea that, you know, perhaps there's lots of capital that would be wanting to cover the types of exposure that they could have access to via someone like Nexus or Steady State. But perhaps the methodology, they're not quite there yet. There's no reason why they can't access that risk. So, for example, you could have, this could even be parametric because it's all smart contract based. You could have reinsurance capital held through a certain system, like names, and that could be, you know, parametric reinsurance for Nexus protocol to allow them to scale their limits. And yeah, there's no reason why that sort of thing can't happen. If that's the direction that the market goes. Sometimes it's the, you know, methodology of placing instead of the fact that they don't want exposure to the risk. So that could be a good collaboration between the two.
Okay, thank you. It's a bit like sort of Who Wants to Be a Millionaire, and it's that time, ask a question. So is anyone, I can see a hand up down there. Corby, if you can pass the mic over, thank you.
Okay, fantastic. I have the question along the lines which you mentioned, that's the new and old. Decentralized finance is all about smart contracts, which is automatic in execution and instantaneous. So if it matches, it instantly pays. The problem with the old insurance, it's not instantaneous, because usually you would have 90 to 180 days waiting period built in any of the insurance contract. The second thing, it's not really automatic, because the onus is on the claimant to show that, you know, his claims would fit the insurance policy, and all of the condition precedent has been made. So it's almost like you have a culture clash between these two walls. How can you bridge it together?
Do you want to try that? Dan.
I'll give it a go. Tell me if I didn't say much. But there are lots of different parts of the insurance space, and I think you don't have to tackle them all at the same time. So I think you can encourage better liquidity in insurance without doing parametric claims, for example. If parametric insurance continues to go in the right direction, you would like to see, you know, a smart contract-driven backend to that. Another example would be because you have capital attached, so instead of it being a traditional electronic placement system for risk, where you're really just representing value within within an exchange, but there's no actual capital. You're just holding the insurance contract so that lots of people can see what's going on at one time. Whereas in our systems, you have collateral attached to the risk. It exists there. It can't be traded anywhere else. You can't ring a favored broker that you go to lunch with. There's a huge amount of benefits to liquidity and all sorts of things in that direction. So it's baby steps, I guess, but a lot of it is just making sure that some of the the hundreds of different parts of the value chain within insurance, some of those are getting getting tackled by smart contracts. And to your point on sort of being automated, I guess my point is it doesn't have to be fully automated to benefit from the value of immutability, transparency, etc. Of these contracts. But it can be parametric if that continues to come, and so it can be automated through oracles and that old story. Don't know if you can add context to that.
I think you brought a really valid question. When you think about insurance, right, it's trust, right? You have to trust someone to create a payout, and if the payout does happen, right, you want to make sure it meets those criteria. And sometimes you believe or under the impression the criteria are hit, and they say no based on whatever data. And there's a need for trust, and in crypto and DeFi is inherently trustless. The parametric model ideally should automate this, right? It should ideally, the criteria and parameters should be set where it can just be fully automated and create a payout. And with insurance, you're inherently relying on some kind of trust. And what I will say is all models, we're DeFi, we're crypto, we're Ethereum, we should be trustless, like you're saying. All crypto or DeFi projects should be aiming towards that. And if they're not, I think their ideology is fundamentally flawed in this industry.
Okay, thanks. I'm getting the magic wave, so I think we better wrap it up. But first, I'd just like to thank my panel for today. I know insurance may seem a little bit dull, but actually it is actually pretty important. And as your businesses grow and get bigger and bigger, it becomes more and more important, whether you're regulated or not. So thank you very much indeed, guys, and enjoy the rest of the afternoon. Thank you. Sorry,